We have Gautam Duggad, who is with us. He's Head of Research, Institutional Equities at Motilal Oswal Financial Services. Gautam, great to have you with us here. Thank you very much for your time. I just want to start with what you're telling clients about the budget and where should they really focus on in terms of announcements and which sectors could get a push, a meaningful push. So let's start there this morning, Gautam.
Sure, Prashant. Good morning. So as far as budget is concerned, we think there is broadly going to be continuity in the direction of policy making, which is basically the overarching focus on the infra, capex, manufacturing and PLI agreed. At the margin, as we have seen in some of the recent state budget like Maharashtra, the government could use the extra bounty of about 1.5 trillion from RBI dividend to provide some sort of relief at the bottom of the pyramid, whether through tax cuts or through some other consumption giveaways. We don't know yet, but that's a possibility because in another 2-3 months, we are heading into a big election calendar again as far as state elections are concerned. We've got Maharashtra, Haryana and Jharkhand in November. And then I think after another 3 months, you have Delhi and then next year you have Bihar. So, the political calendar is always very hectic in that sense. And I think a government does have that leeway to sort of use these 1.5 lakh crore extra money to create some sort of a buoyancy at the bottom end of the consumption pyramid, because that is one area which has been suffering for last 2-3 years, as we have seen, whereas capex, infra, industrials, that segment of the economy has been doing quite well. Rest of the things, there's no point speculating much about it because we have seen now for last 8-10 budgets, we keep speculating this will come, that will come, but eventually it doesn't matter. If you look at markets, they have broadly followed the path of the earnings, especially the large caps. Mid cap and small cap obviously have been completely dealing from the earnings, underlying earnings sort of trajectory. So yeah, I mean, it will create an impact for a couple of days. And then again, I think markets will be back to fundamentals and earnings. So yeah, I mean, that's how we are looking at budget right now.
Hi, Gautam. Good morning and good to see you, Ben. So it's all about earnings. What do you make of a couple of those IT companies that came out with this set of numbers? The street likes it, but they bid up the stocks in anticipation of better than expected numbers. And that's precisely what it is. How are you all placed on tech? What do you make of the earnings and preference in the IT pack?
Sure, Nigel. Good morning. So as far as tech is concerned, we've been underweight for some time. We now moved it to overweight with this quarter's preview and model portfolio revision that we've done. So we are now back to overweight position on tech. Yes, earnings have been decent, been in line broadly. HCL Tech has been a slight beat because of the slightly higher other income. But that's where our preference lies. In fact, if you see, we've now given a target multiple to HCL Tech, which is at a 10% premium to Infosys. This is the first time that we've done it, right? So as far as tech is concerned, we are now turning incrementally more positive than where we have been, not because we are expecting any significant pickup in earnings, but broadly, the valuations look okay in the context of rest of the market. Second, there has been 3 years of a very lackluster growth there. If you look at the earnings growth of tech, that we cover, the last 2 years, CAGR is hardly 5%, whereas Nifty has given close to 20% sort of a CAGR in the last 2 years. So tech has underperformed on earnings front for last 2-3 years now, and stock prices also, keeping aside the mid caps in IT, which has done phenomenally well. The large cap IT has still been trading in a very decent and a fair band of valuation. That is what has prompted us to raise the weight on tech from underweight to overweight, within which we have Infosys and HCL Tech as our preferred large cap bets in model portfolio. And then incrementally, we have added Persistent and L&T Tech in the model portfolio. That's where we stand on IT.
Okay. Gautam, hi, morning. Rima here. So what are the other big portfolio bets or the changes that you've made to your calls in the last 1 month? IT is one, you spoke about it. What else?
So 2-3 big changes we've done, Rima. One is on pharma, where we've gone from neutral to marginal overweight now. Second, we have brought auto down from overweight to underweight. The stocks have done phenomenally well there. Names like Sambardhana Mall, which we had added in model portfolio a quarter back, are up 72% in a quarter. And M&M, which is part of our model portfolio, still is up 40-45% in last 3 months. So auto has done phenomenally well. And that is where we expect earnings to moderate now after 2 years of very sharp earnings growth. So which is why we have taken auto down to underweight now. And consumer discretionary remains a big overweight for us. We have almost 11 consumption stocks in our model portfolio and only two staple names, which is Lever and GCPL, which we've added now by replacing IDC. As far as discretionary is concerned, we have a whole host of names, names like Titan, DMart, Indian Hotels, Zomato, all of that. And then on the mid-cap side, we have Kalyan, KEI, Metro, Sale, all those names. So basically our tilt for last 2.5 years has been towards discretionary, and we've been underweight staples. Marginally, we have made some tactical changes in anticipation of some sort of positive announcements around consumption. Let's see how that pans out. At a margin, rural is also showing some signs of pickup after the decent pickup in monsoon, and management commentaries around staple companies have also started turning slightly better after fourth quarter results. So that is discretionary. And then industrials remain a big overweight for us, whether it is capital goods or real estate. We've continued with our big bullish stance on real estate even now. And then largely private banks is underweight and PSU banks is overweight. So that's how we are overall positioned on the model portfolio side.
Okay, all right. Gautam, what about the real estate theme? You know, some of those stocks have done very, very well. I think a couple of names you all have been positive as well on. You had Shobha, Prestige that did well. And now you have, some of those Mumbai-based realtors like Suntech Realty, which all have been positive on as well. They are playing catch-up. How are you all placed on the real estate theme? And in your pecking order, how does it go?
So, Nigel, we've been positive on real estate for more than 2 years now. I think real estate, which has languished for almost a decade in terms of cycle, is seeing a decent pickup in the last 3 years. And I think we are still in the middle of the cycle. I do expect the developers to behave more rationally this time. And, price growth will be slightly moderate in our view. We think the cycle can get prolonged a little bit. And the kind of money that a lot of these developers can make by prolonging the cycle will be much higher compared to what they get by raising prices too high too soon. So that is a phenomenon. That's a fundamental thought process that we have on real estate. As far as our picks are concerned, we've been holding Godrej property from 1,000 rupees. We still continue to hold it. As you mentioned, we hold Shobha. See, Nigel, real estate is a very top-down macro sector. When sector does well, all the stocks will do well. So whether it's a Prestige, which has been our CY23 top idea, and now Shobha, which has been our CY24 top idea, irrespective of the name that you look at in that entire real estate pack, it has done well in the last 2-3 years, and we expect the cycle in both real estate as well as hotels to continue, because the demand-supply gap is still in favor of demand right now. And we haven't yet seen the beginning of a rate cut cycle. So hopefully, as and when it happens, maybe in CY25, it can act as an additional trigger for some of these deep cyclicals.
Gautam, so especially for markets like now, I'm not saying that it is the case, but are there any other risks? For example, too much... we talk about whether valuations in stocks are getting a little out of hand, but should one start to ask the question for real estate? Especially, but it's very micro market, right? It's not one exchange like stocks. What's happening in Gurgaon is very different from what's happening in Mumbai and other markets, etc. But some have been sort of raising the prospect that especially in a market like Gurgaon, investor, broker demand, etc. is driving most of this price appreciation now. These 2-day sales, everything sold out. And things like that. Does that worry you at all, that the proportion of end-use demand perhaps is coming off and investor demand is rising? At what point does that become a worry?
So, Prashant, we must be asking questions about all sectors all the time, given where the markets are trading at right now. More so for sectors like real estate, you have your defense and railways and all of that. So, to your specific point on Gurgaon, definitely that market is in a very different trajectory altogether. So you have to be extremely cautious on companies which are directly on that market, right? There's no price for guessing that market has become completely exuberant in the last 2-3 years. You've mentioned a couple of points around that, flats getting sold within 24-48 hours of launches and all of that. So as an investor, we have to be extremely cautious around the risk reward inherent in some of those stocks. The broader point I was making was last 2 years, you've seen very strong pickup in pre-sales and business development. If you look at the total pre-sales number of the top 10 real estate companies which are listed, you will see that the pre-sales CAGR has been more than 30%. Business development has been going on pretty strongly, 3x, 4x growth out there. Now, some of that pre-sales business development that has happened 2 years back they are now getting reflected in the P&L. For example, this quarter itself, we're expecting a 40% growth in profit in real estate companies. I know profit is not an operational driver for this stock prices. They depend more on pre-sales and some of the launches. But the fact of the matter is, whatever development that you've seen in the last 2 years is now getting converted into profits and cash flows. And that's where I said, from a top-down perspective, real estate remains to us very attractive. Now, yes, in between there could be rounds of corrections, so that you'll have to bear with. I mean, just look at some of the other sectors that you just spoke about. I mean, in the market, there are sectors like defense, where market cap has gone up from 1 lakh crore, 3 years back to 11 lakh crores now. Railways, again, market cap has gone up from 1 lakh crore 3 years back to 7.2 lakh crores now. While the profit cumulatively has gone from 15,000 to 30,000 crores for both these sectors put together. So on a 30,000 crores of profit, railway plus defense today, the entire listed stocks in these two sectors are trading at a market cap of 18 lakh crores. So that's a trailing P of 60x now. 4 years back, the trailing P was 12 times. So P itself has gone up 5x, Prashant. So you have to obviously be very cautious, especially in mid and small caps, cognizant of what you're buying and what you're paying for.
But what's the overall sentiment? Is it just still upbeat, or do you think, given the overvaluation that we're seeing in certain pockets, you are seeing euphoria set in? Because you also look at valuations, you compare it to the global markets, you track the flows picture in the Indian markets and how the weightages of DIs and FIs is changing in sectorally. Any interesting trends that you've gleaned from there?
So Rima, see, in every bull market, you will always find excesses in some pockets, some sectors. That been the norm. Whether you look at 2003 to 8 or any other bull market in the history, you will always find some sector going into excesses. As far as India is concerned, if you look at Nifty, which is broadly 50% of India's market cap now, it is trading at 20 times, which is on a 10-year basis in line with the 10-year average. Now, obviously, you can dig deeper and say within Nifty, X of financials, the rest of the sectors are trading at expensive valuation. That's fine. If you look at, we've done a good market cap comparison versus profit comparison on trailing 5-year basis. If you look at the last 5 years, Nifty market cap has compounded at 18%. And that's how the Nifty profits have also compounded. So they've kept pace with the market cap. But X of financials, the Nifty profits have compounded only 13% and market caps compounded 90%. So this is a clear-cut re-rating which has happened in the X of financials basket. And that re-rating is even more pronounced in mid-cap and small caps. If you look at the same data for mid-cap market cap is compounded at 27% versus the profit compounding of 17%. And same number for small cap stands at 8 and 28%. So yes, there are pockets where valuations are obviously offering you no comfort. But then that's where you have to dig deeper and do more bottoms up as far as projections and your cash flow analysis is concerned. The second point that you're talking about compared to global markets, do remember, Rima, that India right now on both macro and micro is offering the best combination, 7.5%, 7% GDP growth and close to 15-16% profit compounding for next 2 years on a base of 23% that you've already seen for last 4 years. The important ponderable is where does flow stop? Because that has been a very important part. Because you look at the first 6 months of CY24, the total flows are $28 billion, which is 30% more than what you received in entire CY23. And if you stretch that comparison to, let's say, last 30 months, which is beginning 1st Jan 2022 and ending to 30th June, so 2.5 years. In that 2.5 years, total cumulative FI flows are just $4 billion, out of which 3.5 came in June. But corresponding DI number against that 4 billion is 82 billion. So yes, in a bull market, till the time your flows are very buoyant, the underlying valuations can get delinked from earnings in the short term. But over a period of time, they have to catch up with earnings. Either the earnings have to catch up with the market cap, else the reverse will happen.
All right, Gautam, thanks a lot for joining in and filling us in with all of those details. I like the report you put out on the retail rhapsody, as well as the important point they're making. Everyone's talking about market cap going up, but even earnings have gone up at a similar pace. So that's why, there's not been, the markets are not as expensive as someone thinks.